Hello and welcome again to Microeconomics. We're going to continue our discussion of various different factor markets today. We've talked about labor. Today we're going to talk about probably the second most important to individual households, and that is essentially the market for loanable funds or savings, or as we've titled it, interest. And it's really the underlying principles behind why people are paid interest and how that's calculated and how it comes into being. So let's first talk about how money comes into being to begin with, or how interest comes into being to begin with. Production essentially is somewhat of a roundabout sort of thing. One of the reasons for that is because in our society we use an awful lot of capital to increase our productivity. Now, capital, one way of thinking of capital is it's similar to a savings account. It's kind of like a savings account. We do without today in order to receive more in the future. We're sort of saving back a little bit of today's production in order to get more in the future. It requires savings today in order to, or out of current consumption in order to have more goods and services in the future. Now, consumers have a positive rate of time preference. That is, they value present consumption more than they do future consumption. If you're given a choice of receiving $100 today or receiving $100 at some point in the future, then you would prefer to receive $100 today. And the reason for that, there's actually two reasons for that. First, you're impatient, and you'd rather have it now rather than having it in the future. But the second reason is there is a level of uncertainty associated with future transactions. And so as a result of that, interest is the reward for postponing consumption. The interest rate represents how much you receive to reward you to do without today in order to receive more in the future. On the other hand, demand for savings is actually what we refer to as investment, and it is firms who are actually going to use those funds in order to increase their productive capacity. They, as is always the case with production processes, exhibit diminishing marginal returns to that capital as well as any other factor of production. When we looked at labor, we saw that there was diminishing marginal returns to labor. As we added more and more laborers, eventually we began to see their additional product diminish or turn downward. Same thing's true with investment as well. As we invest more and more, the amount that we receive from that investment, the extra we receive from that investment, eventually will decline as well. So we might look at an example where we're adding farm equipment. And you see here that if we have no equipment at all, we'll produce 200 bushels of wheat without any sort of capital whatsoever. If we add a tractor tiller to that production process, then we receive 1,200 bushels of wheat, which is a net addition, a marginal product of 1,000 bushels. If we also use a combine, we'll produce 2,000 bushels of wheat, which is a net addition, a marginal product of 800 bushels. Irrigator adds 600, Harrow 400, crop sprayer 200, and then we get to the point where we have a post hole digger which adds absolutely nothing. Now you note in this case that the diminishing marginal returns begins from the very start, where our marginal product begins to diminish from the very first piece of equipment. Now if we take that marginal product, that is the number of bushels, and multiply it times what we get for each bushel, then we end up with, which is $4, then we end up with the marginal revenue product. The marginal revenue product is the dollars and cents version. In column 3 you have bushels, in column 4 you have dollars and cents. And so what we're going to try to calculate is the marginal return, which is what we're going to receive from it divided by what it's going to cost. Each and every piece, for simplicity's sake, costs $10,000. So for the tractor tiller, we receive a 40% return. That is the marginal revenue product of $4,000 divided by the $10,000, which gives us 40%. For the combine, we receive a 32%. For the irrigator, 24%, and so forth. So you see that the marginal rate of return also decreases, and the reason it does is because the marginal revenue product is decreasing. If we had different prices, of course, we would divide by, if we had different prices in column 5, we would divide by different prices. So what we will want to do, we will want to invest at a point where the marginal rate of return is equal to the cost of that. That is, where the marginal revenue product, the marginal revenue rate of return is equal to the marginal resource costs. So since we have diminishing marginal returns, we'll simply compare the market interest rate, which is our cost of borrowing, with what we're getting from it, and as long as the investment returns us more than what it's costing, then we'll do it, and once the investment returns us less than what it's costing us, then we won't do it. So what we end up with, in this case, we actually end up with sort of a step function. We don't end up with, since this is discrete or integered values, we don't end up with a line, we end up with a step function. And you can see that the first investment returns us 40%, then 32%, then 24%, and so forth as we make more and more investments. Now, all we need to know now is what are funds going to cost us, and then we can determine how many we want. So we'll increase our investment as long as the rate of return is greater than the interest rate. And so once again, we have a derived demand. The demand for investment is actually derived from the marginal return curve, and so we could just join all those points together and end up with what would be more traditional looking demand curve in which we have a diminishing marginal productivity. Now, a very special case of this is the case in which we have intellectual property. Intellectual property occurs when you have an intangible asset. It's a human knowledge or an idea, an asset that you can't really put your hands on. They're typically very costly to produce, but once they're produced, supplying additional units are typically very low cost. So you might think about, as an example, a software program. Producing the first iteration, the very first copy of the software program is fairly expensive, but each additional piece is not very expensive. The result of that is that the market itself can't really handle that sort of thing, because once the idea or the property is out there, it'll very quickly be duplicated. And so we end up having to protect it with patents, copyrights, and trademarks, where a patent is a special provision to protect an invention or a technical advance. A copyright is the same thing, only it's for an artistic expression, such as something done by an author or an artist, a composer, or even the computer program that we mentioned before. And a trademark is some sort of a unique symbol or a mark or something of that sort. Since enforcing property rights under these sort of circumstances is extremely costly, in general what would happen is we wouldn't produce these sorts of goods. It's really expensive for you to enforce that protection. Again, think in terms of a computer program, it'd be extremely expensive to track down everyone that made copies of your computer program. So there's really not much incentive for you to produce that computer program because you can't receive any of the pay for it. And so we have to enforce those. Those are enforced through the social system, that is through property rights created under the court system, in order to make it worth your while to produce such products, which are intellectual property products. Now, we might think in terms of what determines what the interest rate actually is. And the interest rate is actually determined in the same sort of sense that all markets are determined, that is, the intersection of the demand and supply for the good. In this case, the demanders of the loans are the entrepreneurs who want to start firms or invest in physical or intellectual capital. The suppliers or households which are willing to forego present consumption and invest that consumption for later use. And so the demand for loanable funds is a negative relationship and the supply as a positive relationship. Now, this, of course, as always, means that we're going to hold all of the other important things constant. In this case, it would be price of other resources. That is, we oftentimes have to use resources complementary. The amount of technology, that is, the available technology that you could implement in capital. And one way of thinking of this would be that in some capital investments don't happen because there's no newer technology. There's no reason to invest in new capital because the technology hasn't advanced. And finally, one of the things that affects this resource that doesn't typically affect resources is changes in the tax laws. It's typically the case that tax laws give special treatment to capital investments, whereas they don't give special treatments to, say, labor or land or some other resource. So if we looked in terms of what's actually going to happen, the banks serve as financial intermediaries, and perhaps it might be better just to think of financial intermediaries. They're the go-between between the savers and the borrowers, and they help determine the actual interest rate as a result of the interaction of demand and supply. So we can see that the interest rate here is determined at 8%. As a result of an interaction of $100 billion worth of loanable funds. If demand were to increase, perhaps there was some new technology that came on board, or perhaps some change in the tax law caused demand to increase somehow, then we would see an increase in the interest rate from 8% to 9%, and an increase in the funds that were exchanged from $100 to $115 billion. Now, one of the things that you observe when you start thinking about interest rates, often people say, well, you know, what's the interest rate going to do? And that always is kind of a mind-boggling question for me, because I'm not sure what the interest rate is. Because there's really a lot of different interest rates, and they vary for a number of different reasons. The most important one is the riskiness of the loan that's undertaken. The more valuable the collateral is, the lower the interest rate. The less risky the borrower is, the lower the interest rate. So one primary reason why you observe multiple interest rates in society is because there is a difference in the riskiness associated with the loan. There also is a difference due to the duration of the loan. The interest rate tends to increase as the duration of the loan increases, and so it's typically more expensive to borrow for 5 years than it is for 3 years. And there is a link between administrative costs and the size of the loan. Administrative costs are typically sort of a fixed cost. That is, it costs about the same amount to draw up the paperwork and register the paperwork and print the coupon books and all of the other things that are associated with the loan. So the larger the loan is, the smaller that amount represents of the overall loan. So small loans are very expensive to do, whereas large loans are pretty inexpensive. And as we referred to before, tax treatments tend to change. Taxes surrounding interest payments have changed through the years. Originally, all interest was tax deductible, but now it's only deductible under certain circumstances. So you can see that, and these numbers are probably pretty old, but you can see here that there's a difference in various different categories of loans. Home mortgages tend to be less risky. The collateral is usually fairly easy to assess the value of, and it's not going anywhere. Whereas car loans are a little bit more expensive because, in general, cars are a little more mobile and a little bit riskier, and things can happen to them. And so you see various different other levels of interest rates based on riskiness and duration. Credit cards are particularly expensive because there is no collateral pledged to those, and they have a high default rate, and so as a result they have a much higher interest rate. Now, one way of comparing things, one of the things that we get into as we start thinking about money through time is how do we compare the present value of that money with some future value of that money. If we wanted to ask the question, what is $100 someday in the future worth today, since we prefer the $100 today to some $100 in the future, obviously it needs to be discounted. That is, we're not willing to give you $100 today to receive $100 at some point in the future. And that's known as present value. The present value 1 year hence is equal to the amount to be received 1 year from now divided by 1 plus the interest rate. The higher the interest rate, the lower that amount's going to be. The lower the interest rate, the more that amount's going to be. And so there's a formula for doing that. And that formula is the present value is equal to the amount M of dollars divided by 1 plus the interest rate raised to the T power, where M is the amount that you're going to receive in the future, T is the number of years in the future, and the interest rate is equal to I. Again, remember the larger T is, that is, the further it is in the future, the smaller the current value is going to be, the smaller the present value is going to be. It's also the case that the larger the interest rate is, the larger I is, the smaller the present value is going to be. And here's an actual calculation. Suppose we wanted to figure out what is the value of receiving $100 1 year from today plus $150 2 years from today. And suppose the interest rate is equal to 5%. Well, obviously that's not worth $250 since you receive one 100 a year from now and you receive the other 150 2 years from now. So the present value, you see the calculation there, is 100 divided by 1.05 plus 150 divided by 1.05 squared. And if you work all that out, you'll see that it's equal to $231.29. Again, it's not worth $250 because it's at some point in the future, and so as a result we have to discount it or bring it back to a current value. A special case of that is a case in which we have what's known as an annuity. An annuity means that you receive a certain amount of money each year and you receive it from now on. There are contracts that are known as annuities. People use those sometimes when they're doing a retirement where they deposit a certain amount of money and they receive back a payment every year. That's a special case of present value in which you can simplify that equation and make it equal to M divided by I. Which brings us to an interesting question. Suppose you win $1 million in the lottery and your payment is $50,000 a year for 20 years. Is that really $1 million? Well, in fact, it's not. It's actually $425,700. And that is the value of that $50,000 for each of the successive years from 1 through 20. And in fact, what happens is the lottery officials actually go out and find a company and they pay them something similar to the amount that you see here and say, now you pay him off every year. We don't want to bother with this anymore. And typically insurance companies do that sort of thing. In fact, it's very similar to what we said a second ago about a retirement annuity, in which you simply pay them a flat amount of money and then they repay you every year from that point on. If you did that, if instead you took it as a lump sum, then what the maximum they would be willing to give you is the $425,700 because they could do away with that benefit for the same amount. And then after taxes, you only receive some portion of that. So who knows, it may not be worth your while to even play the lottery, had it. That's all we wanted to talk about today. Interest is probably the second most important source of income for most households, and so of course it's very interesting for us, and it's important for us to understand exactly how that's calculated. That's all for this time, and we'll see you next time.